The housing market is in the midst of a shift of momentum. Adjustable rate mortgage demand doubles as interest rates hit the highest level since 2009. So what does this mean for the housing market? Are we going to see a slowdown, a softening, or an outright crash? We've been talking about the housing market over the last year or so. And my opinion is you're not going to see a crash anything like 2009, even though rates have hit the 2009 level. A lot of people were predicting a housing market crash because of the pandemic forbearance program and forbearance on evictions, rent evictions for people that were behind on their rent, things like that. The assumption was there were going to be a lot of landlords that were going to want to sell their properties. There were going to be a lot of people in forbearance that were going to go into foreclosure and have to sell their properties. And I disagreed with all that because the inventory levels are just unbelievably low and have been over the last 6 months specifically, but over the last year to 2 years since the pandemic hit, we've seen record low inventory levels, and we've seen a whole different environment in terms of the lending climate. So even though rates have hit all-time highs, it's going to take some time for that to soften the housing market so inventory levels can build. Builders are building as fast as they can. Housing starts are at record highs as well. So it's going to take a little time for all this to catch up. So let's talk about what this really means. The news today is that adjustable rate mortgage demand doubles as interest rates hit the highest level since 2009. The average contract interest rate for a 30-year fixed rate mortgage for a conforming loan with a balance of less than $642,000 or $647,200 has increased to 5.37 from 5.2, the highest rate since 2009. The adjustable rate mortgage share of applications last week was over 9% by loan count and 17% based on dollar volume. At 9%, the ARM adjustable rate mortgage share was double what it was 3 months ago. Applications to refinance fell 9% because rates are higher, obviously, for the week, and were 71% lower than the same week a year ago. Mortgage companies are laying off because the demand is dropping for refinances due to the interest rate level, obviously, and for purchases as well, also due to interest rates. So the real question is, what was the cause of the housing market crash the last time? It was two things. One, it was the subprime mortgage lending environment where people that were not qualified for mortgages were buying homes, investment properties, bigger houses than they could get. And it was exotic loan offerings and interest-only loans because rates were a little bit higher. The only thing that made sense and made the properties affordable at the values that they hit were adjustable rate mortgages, interest-only loans, pay option arms, things like that. And then for qualification, it was no doc loans, no income verification, no documentation loans. So we're not seeing that this time. Right now, it's much more traditional to qualify for a mortgage. You have to qualify, you got to have good credit, you got to have the income, and you have to have a down payment. Obviously, there's different loan programs where you can limit your down payment for first-time home buyers, VA loans, things like that. But that's a very small percentage of the mortgage market. Most of the loans that have been originated over the last several years with these record low interest rates are long-term loans, fixed rate, with qualified borrowers. So you're not going to see an increase in defaults. Now, you might see if we get to the point to where people start taking out interest-only loans, and we're going to see this in the commercial markets where interest-only loans are used, but we're talking about the housing market. If people start taking out interest-only loans and loan rates go up while values drop, that's when you will see strategic defaults and people kind of walking away from properties. Because if your property payment is going up and the value is dropping, that's kind of one of the things that happened as a result of the 2009 housing crisis. Things were fine up until the bubble popped. And what happened was the values of the properties were dropping because the liquidity dried up. So you had the subprime lending market that blew up, and then the banks started failing because of all of these loans that were going into default and that became underwater. So it was a banking crisis, and it was a mortgage lending problem that created the housing crisis last time. Of course, it was the catalyst was the Fed once again, dropping rates to record lows, creating the bubble in the first place. Then the push to get people into homes that weren't qualified with Fannie Mae and Freddie Mac, and the loan products that were being created that were being packaged into derivatives and sold to Wall Street. being rated by the same rating agencies that were offering these things as security. So it was a very interesting time, and we haven't seen that occur. But what was happening was interest rates were going up, so people's payments were going up, but the values were dropping. So people just threw their hands up and walked away because it just didn't make any sense, financially, to keep going, keep paying on a property that was in default, that the value was dropping, and people, just didn't see, any kind of daylight or light at the end of that tunnel. And it took about 10 years for values to get back to where they were in that 2008 or 9 peak. And if you look at some markets now, prices are, just recently crossed the level that they were at the peak of the housing bubble back in 2008 and 9, because they dropped from that point down to lows, record lows after that. So prior to 2008 and 9, like 2007, 8 timeframe, the values of housing were at all-time highs. It dropped in some markets about 50% in 2009, 10, 11, 12, and it started bouncing back over the last several years. And now we're back to a level above where we were in 2009. So it's taken that long for values to get back to where they were. And we're starting to see signs of a correction, because with interest rates where they are now, if somebody was going to buy a house for $500,000 at interest rates even 6 months ago in the twos, now you can only buy a $350,000 to $400,000 house with interest rates where they are now. And the indications are that we're probably going to see mortgage rates get close to 6 or 7% before long. They went to 5% to this record high level that we haven't seen since 2009, way faster than I thought, way faster than a lot of people thought. I didn't think we'd see these rate levels till we got closer to the end of the year. We might see 6 or 7% interest rates in mortgages before the end of the year. So if we see that, you're going to see a lot of interest-only ARMs, pay option ARMs that negatively amortize, adjustable rate mortgages, all kinds of different creative instruments. Like when I bought my first house in 1990, I bought on what was called a 3-2-1 buy down, where our interest rate was 7 3/4 the first year, 8 3/4 the second year, 9 3/4 the third year. So back then, 7 3/4% interest was a good interest rate for a loan. And, even 5% has always been a really good interest rate for a home loan. So it's perceived as high now because of where we came from and from what people were getting before, and the level of the cost of housing and where it has increased to now. So all of those things take time to work out because of the inventory levels, but we are seeing softening in a lot of markets. We're seeing price reductions. We're seeing days on market go up. We're seeing less competition for homes in some markets. And but then there's pockets where you're still seeing properties sell with multiple offers in days, but instead of having 20 offers or 10 offers, you're seeing 2 or 3 offers, things like that. And a good friend of mine just sold his house the other day. It was a $2.2 million house that sold in a couple of days with a couple of, I think it was only one offer, but a couple of showings. Still very fast, but that was in a market where there's almost no inventory and very unique, type product. So interesting times. We'll have to track it, see what happens, but the market is softening. Values are starting to correct in some areas, but again, real estate is hyper local. Every market's different, and it's going to take time for that to correct based on interest rates. And of course, it's all about demand. The areas of the country, the Sun Belt, where people are moving to and have been moving to, and then areas like New York City, where people are moving back to, there's a lot of demand and not a lot of inventory. So it's going to take a little bit more time for certain areas to correct. But keep your eyes open. I don't think we're going to see any kind of a housing crash. I don't think we're going to see anything like that. But I do think you're going to see, and actually we are seeing, prices correct. We're going to see values correct, and we're going to see some of that come back into balance. And it's really 6 of one, half a dozen of the other. So prices went way up. Interest rates were record level lows. So as interest rates go up, prices come back down. So it's kind of 6 of one, half a dozen of the other. Really, it's kind of negligible. And what it boils down to is the ability to borrow money. That's what killed the housing market the first time. High interest rates triggered defaults, which triggered a bank failure, which created a problem and a lending crisis. And right now for the economy, one of the biggest things lurking out there is the credit markets, not mortgages, but commercial credit. So that's something where there are some cracks that are starting to show that are going to affect the entire market because it's systemic. So we'll have to see how that plays out. But anyways, that's my update on the housing market. I hope you have a great day. We'll see you on the next video.